Hey folks, this is Clayton Collins, CEO of HW Media, and your host for the Housing News Podcast. I literally just got off a plane and came into the HousingWire office here in Dallas, Texas to record the intro for today's episode. I've been out in San Jose, California at the Mortgage Bankers Association Technology Conference all week. And on the back end of MBA Tech, I couldn't think of a more appropriate episode to drop than my interview with Matt Rocco, chairman of the Mortgage Bankers Association and also president of Colliers Mortgage. In today's conversation with Matt, we talk about how quickly the market is changing and how that impacts banks, both depositories and mortgage banks, and how that flows through to impact on loan originators. We take a very holistic view of the residential housing market. Given Matt's strong background in multifamily and CRE, we like to take an approach that connects what's happening in the rental market and how that impacts and relates to what we're seeing in the single family homeownership market. And finally, we take a look at current CRE outlooks with specific consideration given to the impact on small U.S. lenders and some of the news that we've seen in the market about GSE credit loss preparation. I hope you enjoy this episode today with Matt Rocco, chairman of the MBA and president of Colliers Mortgage.
Hi, this is Sarah Wheeler, editor-in-chief of HW Media, and I'm talking to Ed Messman, CEO at Rook Capital, about their shared value investment program. Ed, how is Rook Capital creating new homeowners?
Yeah, the shared value investment that we created helps prospective new homebuyers by adding up to 25% to their down payment in exchange for an equity position in the house. By doing that, you effectively lower the monthly cost of homeownership to a level that's affordable and within their budget.
Thanks, Ed. And listeners can find out more at rook.capital.
Yeah, if you think that the consumer is under more pressure than we understand quite yet, I think that would also imply that we might be in a precursor to inflation falling off pretty quickly. To me, the data shows that the strong wage growth of 2021 and 2020, the first half of 2022, are going to fall off pretty quickly in 2023. And there's sort of a spending hangover that's going to happen, or an inflation catch up, when people start to see wage growth decline and prices sustain from the last 48 months of inflation, or 24 months of inflation. Do you think that dynamic, if you agree, will influence the Fed action over the next couple quarters?
Yes. First, I think the 2% target is the wrong target. Okay. I don't know that we've had 2% inflation for a long time. I'm not sure that we even measure inflation in this country properly. And I'm not sure some of the tools we use, back to your earlier comments about banking and the rapidly changing environment there, are actually germane to where we are today in the economic cycle, whether it's the Taylor rule, the Phillips curve, or what have you. I don't think that they're reliable predictive indicators of what might be coming. So we need to be careful. When I grew up in the bond market, it was always said the bond market is never wrong. It just might be a little early. And yet we see conflicts between the equity market and forecasts and the bond market, and what the Fed has done or expected to do is being, quite frankly, very disintermediated. So if we were to recalibrate back to that word, a true target inflation rate, and if that were closer to 3 or the low threes, I think that would be appropriate. I think the Fed moved very quickly. There's no doubt perhaps they started too late and had to play a big catch up. But the danger of what they did was in plain sight. So it's hiding in plain sight when they said, we're going to take rates a quarter and then a half and then 75 basis points, and we're not going to stop until. So it's a little bit of a shame on the market for not adjusting more quickly to those, whether you're managing duration or liquidity or your asset portfolios. You really needed to do that early on when the Fed said that we're going to increase rapidly and stay there for a long time. I think, however, though, back to the mechanics of where we are in the Fed and what that means to inflation is just squarely in what you said. The consumer, in my humble opinion, is stretched. I do believe that credit will be curtailed, and that will have not only disinflation, but deflation to some of the space. And quite frankly, trees don't grow to the sky. So rents, whether you're in the office space, are declining rapidly. Whether in the multifamily space, they can only grow as fast as wages can grow and some other things, along with some of the supply balances and counterbalances that are in place in the many economies of real estate and finance today, that we need to find a footing again. But inflation, no doubt, will come down because it has to, because of some of those same stressors in the systems and some of the disintermediation we're going through right now. And then there's also a question on how strong is the consumer and where does this consumer come out? Where do they spend? I think we'll always have those pockets of inflation, and we'll have to be very careful on how we deal with them, whether it's in medical, whether it's in some business services because of supply chain still challenges and disruptions. But those are more isolated. And I think trying to paint the economy, particularly the inflation economy, with such a broad brush, quite frankly, is dangerous and perhaps even destructive to parts of the economy.
Interesting. So, Matt, in this conversation, I really do want to dig into some of your viewpoints on residential and commercial real estate lending, specifically into some of the issues we're starting to see pop up in office and multifamily. But I want to pause for a second and kind of go back and tell the audience your history in the industry. And I think when we started coordinating this interview, you were in a previous role at Grambridge, and you've recently stepped in to a new role leading Colliers Mortgage, and you're also serving as the MBA chairman. So we'll come back to MBA chairman, but tell us a little bit about your career in the lending ecosystem and what's kind of led you to this most recent role at Colliers.
Yeah, sure, Clayton. Listen, and I'll tell you, it's one of the most boring stories you'll ever hear. It was really just born out of being surrounded by great people. So it starts with, a great and supportive family and friends, and then grew that into an environment of business, to your point, for which I was part of the foundation and building a company for 24 years. I'm very proud of that. But the market's changed, and the dynamics of the beneficial owner of that enterprise, as well as expanded and more comprehensive opportunities that I saw necessary in service to our clients. So took the opportunity to come on over to Colliers. And again, it is so fortunate for me to be proud of what I was part of building, again, for decades, and then also a great opportunity to see what we have in front of us today at Colliers. But my background is like many folks in the capital market space has been, in certainly the bonds, the restructuring, the origination, the servicing, the asset management, production, and then in leadership. And it's within that framework, which is quite wide, but always concentrated around capital markets or commercial real estate. And now as part of the MBA and other trade groups, the residential marketplace, something that I just feel honored to be a part of. First of all, it's an economy of wonderful people doing wonderful things for the businesses and communities for which we serve, while at the same time being able to, I think, have a positive impact on what we can do, again, for our teammates, for the communities we serve, and the businesses that we build. So I've just been a very, very small part of that, but it's always, with a great group of friends and supporters that gives you the opportunity predicated on past success and performance. And I would just say that that's been the cornerstone for me as I move forward in kind of my career journey.
Most recently at your prior firm, were you entirely focused on multifamily, and has Colliers kind of stepped you into different asset classes, or how has that kind of focus shifted?
Yeah, no, we were not. We actually were a comprehensive provider of capital markets products and services. But we did it, I would say, reflecting market conditions. And
Okay.
when the market and the investors, providers and users of capital for which we represent were, predominantly focused on multifamily because it was the hottest investment rock out there, generating the best returns, risk adjusted or otherwise, and capital availability was extraordinary. We kind of just found our way to that, but always representing the commercial economy, which included, whether it's office, retail, industrial, or special purpose properties or things of that nature. Now, it is true, however, though, being a part of an international company with about 18,000 teammates in 65 countries around the world, with very deep capital markets programs, products, and services that we can deploy as a principal or advisory on top of the other lending that we do through our correspondent and or proprietary models is extraordinary. And it is in part because it's not an unregulated environment, but a different regulated environment from those under like an FDIC scope of supervision. So it's different, broader capabilities, enhanced products and services, and look forward to building that out because it's a very exciting time, not just in the industry, but to be a part of Colliers.
Yeah, it's definitely an interesting time. And I'm sure you stepped in at a time when I'm sure you anticipated some interesting responsibilities. I think you probably had a pretty good vantage point as to some of the challenges, not all the challenges, not the SVB failure, but a vantage point of some of the challenges we'd see in 2023. And in Q4, we were already seeing Fannie Mae starting to write down some credit losses on multifamily loans and, signal for some loan losses in 2023. How did the changing market dynamics influence your desired next step and influence the career decision you were making and kind of, give you some intuition as how you'd be spending your time in the coming years?
For me, it had to be surrounded by very comprehensive products and services. The market is changing rapidly. Capital needs for providers and users is changing by the day. And what I did see was an economy that was going to decelerate in all aspects, including commercial real estate, and being able to provide gap equity, structured finance products and services to fill that gap, while at the same time having direct and indirect equity capabilities was a positive differentiator that I knew our clients in the market needed. So it was a very easy decision. And when it's the right cultural fit and you have a superior platform with great opportunity for growth, a lot of blue sky, if you will, that's really the fun part. The more challenging part, for which you talked about, is those are difficult times. In fact, it's because of the black and blue marks that I have and others in the industry that we can learn from some of the mistakes made, whether it be the GFC or whether it be through other points of disintermediation in the capital markets, real estate markets, commercial and residential included, that we need to learn from so as not to repeat them. And first and foremost, it's about liquidity. Liquidity sets asset values. By and large, when interest rates went to zero over the last, 24 months, if you will, even a year ago, Clayton interest rates were effectively, I think SOFR was 25 basis points, and the Fed was just beginning their march on higher rates. There are no business cycles, and asset values, quite frankly, grow too far too fast. And I think we have to, again, adjust, recalibrate ourselves to those changing market conditions of discipline in credit, in underwriting, and then quite frankly, having the equity capital readjust their return expectations, again, to a new interest rate environment. So that's challenging, but I think with the platform that we have and with the experience we have, we feel very well suited in serving and advising our clients on those difficult but necessary adjustments that need to be made.
At HousingWire, we're much more focused on the single family side of the residential ecosystem, but I am based in Dallas, Texas, a market where, which is incredibly active hub for multifamily operators and investors. And some of the multifamily folks that I speak with are, starting to get the sense or get the inbound calls that there's some GPs, some operators out there that are so far from positive carry. They're bringing portfolios to market right now, and it could be an active year for buying and selling multifamily assets. But those deals will need creative financing sources, as the LPs of the last run aren't necessarily as excited about putting capital to work in this market. Is that the kind of deal that I don't want to say Colliers, but like lenders like Colliers can be creative in with gap financing, or how like where do you come into play in this type of market?
Yes, Colliers can. So full stop there. We have the products and services, and we're developing new innovative capital solutions right now to meet market demand for this, but others can as well, Clayton. And I will tell you that you nailed it. I mean, quite frankly, that equity needs to adjust. So here's the deal. We bought the deal at $10. in early 2021, perhaps. It's now worth 8. But because we perhaps overpaid at the time and cap rates were so low, we were only able to borrow 6. So we still have, if you will, that positive margin of safety between the lender and what I'll say the equity, but that doesn't help the equity that gets wiped out to the $2 in that example, if you will. So the equity, unlike the GFC, is going to take the hit. The question is, will that margin of safety prevail? Is it enough? That $4, or does it get eroded, evaporated, or turned into some sort of future hope certificate for those investors? I actually subscribe to the future hope certificate. You're going to need white knight equity or structured finance vehicles to come in to recapitalize these transactions. While there may be some equity, the V, if you will, in net asset value is hard to determine right now. Investment sales have been slow. I do think investment sales pick up, but by necessity, driven by maturities. So I don't think we're going to see a lot in 2023. I know there's a maturity list out there produced actually by the MBA, but I think built-in one-year extensions will be the norm, and we will not be able to kick the can like we did post-GFC, but we will allow, if you will, some owners to reconstitute equity, test the metal of that equity, bring in that white knight equity, so as not to, have forced sales and liquidations, which immediately turn into lower asset values and in losses for those same credit holders, banks, or what have you. So I do think it's going to be a challenging year in that regard. And quite frankly, Clayton, someone's got to take the hit. And I see the hit coming to the equity. And quite frankly, in a capital markets economy, that's where it should be.
Well, it's going to hit the general partner carried interest first before it even hits the primary equity that came to the deal. And I think that's what's I guess has me not concerned, but sensing a transaction flow, because misaligned incentives do change markets. And even if the lender's safe, primary equity is primarily safe, if the GPs aren't incentivized to run this asset for 2, 3, 5 years, that can create a market where there's more transactions.
When interest rates did go to zero, commercial real estate awkwardly, offered a higher yield, alternate fixed income type environment for investors. And while there are copious amounts of capital in the system looking for a home, commercial real estate is an important diversifier, found some of that capital. I'm not still sure that commercial real estate, and I'd like to differentiate between the residential side, although there was some of that. I don't think they could spell CRE. So I think we're going to see a rotation of those same yield hungry investors out of CRE beginning in 2024, lasting through 2026. And that will cause pain. We'll have to replace those equity interests, or that equity will be completely diluted with new equity to come in just to refinance. So again, back to that example, you still have a margin of safety or some equity to the purchase price, but that's now been discounted to current market values. Oh, and by the way, even though you only borrowed $6 from the bank, you don't even have positive cash flow right now because of current interest rates, because of hedging costs, derivative costs, or things of that nature. So you actually need the new equity come in just to refinance the loan. And that's going to be more challenging for investors that really aren't, if you will, committed to the space. So I think we'll see a rotation out to more real estate savvy, friendly, or understanding investors that understand the capital composition, the capital call needs, the management expertise, and of course, duration and lack of liquidity in the investment class itself.
And if risk-free yield is a lot higher than it was 2 years ago, does that put an additional layer of pressure on asset prices? If investors can get fixed income or treasury or muni yields in the 4 or 5% range, they're definitely not going to take a risk-adjusted yield for something only a few points higher.
No, negative leverage is real right now.
Yeah.
Again, driven in part by the amount of floating rate debt and that asset valuation increase that occurred. And it really began in 2017, but accelerated with low interest rates and copious amounts of capital in the system. And yeah, that's going to be a real challenge to see where that ultimately plays out and where it lands.
So the Mortgage Bankers Association that I am most familiar with, and our exposure via HousingWire, is this owner-occupied single-family residential market. But I understand the trade organization represents the entire mortgage industry. I'm interested in like kind of your capacity as a commercial real estate lending and real estate professional. How do you come into the larger organization and kind of play a role impacting and representing lenders of all different shades and strategies, from depositories to IMBs on the resi side to the different types of lenders on the CRE side?
It's a great question. Thank you. And I can only do it with the support of the MBA and all the team members and staff there that help with not just the direction, but the foundation of what it means to service those 2,100 member companies throughout the country. It's truly extraordinary, but please, Clayton, it's not that difficult. With that backstop of support, and then with awareness and knowledge of the capital markets, real estate as an investment, whether you're a residential owner or whether you're a commercial owner or investor, the thesis is about the same. Looking for positive, longer term returns, looking for opportunities for growth or asset either preservation or enhancement. Some of the associated tax benefits with both residential and commercial. So it's been that part of it foundationally is quite easy. On the capital markets side, in times of disintermediation, first driven by COVID, second driven by housing value and if you will, affordability and the challenges all around affordable, both in single family and multifamily is interesting, but we also represent those commercial interests in the MBA. So think about the office that we're going to go through and kind of the unwinding of what that looks like. And then also on the single family side, we talked about, single family homes for rent, built for rent communities and what that means to housing supplies. And then quite frankly, there's something else which is fascinating to me in just doing some quick research. What happens with the priority of payments? And I'll speak specifically to the residential side. But I was with some friends at a roundtable meeting recently, and they said, "Hey, did you know that this car company has something, and if you ever miss a payment past the grace period, that they can shut down your car and you can't start it? Oh, and by the way, the cell phone companies have those same, rights, if you will, by force when you sign those agreements."